Hey everyone, this is Dylan Lawrence Moore with the Volitional Science Network with Nima Mahjour from economicsjunkie.com on the line. And we decided, with all this MMT stuff that we've been doing, it's time to start making rebuttal videos to people posting videos about economics and most specifically, the impending doom that's supposed to happen.
To people doing economics poorly.
Thank you. To people doing economics poorly. So, Nima, please tell us, is the impending doom tomorrow or before next year or after next year?
It depends. It always depends. Yeah.
Okay, so the specific rebuttal that we wanted to do is Mike Maloney, who's a really smart guy and he puts out a lot of really great videos on money, went on Stefan Molyneux's Freedomain Radio show, and Stefan interviewed him about the impending dollar collapse. Have you guys heard of this? Did you guys know that the dollar was going to collapse tomorrow? You did hear about this, right, Nima? The dollar's collapsing tomorrow.
Yeah, I've never heard that on Austrian economics channels.
So we're going to go through and go point by point, what Stefan says and what Mike says, and view it through an MMT point and assure people the dollar is not collapsing tomorrow. So, you ready, Nima?
Ready.
Okay. So, this video between Stef and Mike, it starts out that they get on and they have a little bit of chit-chat, and then after the chit-chat stops, the first thing that comes out of Stef's mouth is bringing up the fact that he knows that the Federal Reserve is actually a private bank, and it's about as Federal Express. And he philosophically he makes the argument. He's like, hey, I understand it's private, but because it has the monopoly on currency, it's public, but he understands it's not like a direct arm of the government. And Mike responds to him saying, it's a hybrid, it's sanctioned by the government, but there's privatized profits from the Federal Reserve. So, Nima, is the Federal Reserve actually a private bank?
So, there's a lot of debate on this in terms of the Fed was legally set up like a corporation. So is it private or not? If we look at all the important factors that make up the Federal Reserve, in particular, Maloney's claim that it's privatized profits, the fact is that the U.S. government receives around 98% of the Fed's annual profit. That's
98%.
Yeah, that's not
9-8.
I mean, I've yet to find a private company where that's the case. The Fed was created by Congress. The membership is mandatory for national banks by government law. The ownership of its stocks is mandatory for national banks by government law. The stocks can't be traded. You can't buy stocks in the Fed.
Damn it.
The Fed's governor is appointed by the president, confirmed by the U.S. Senate. The Federal Open Market Committee is under majority control by the Board of Governors, which is appointed by the government. The dollar bills, etc., are produced by the Treasury. The Fed is protected from competition. So these are all factors that you don't see in a private company. So for practical purposes, we can assume that the Fed is a public institution of the U.S. government.
And then didn't you mention to me that of the 2% that's actually getting paid out to somebody private, isn't it like 6% return?
Yeah, there's a 6% dividend in the stocks that it's a preferred stock dividend that the banks that are members of the Federal Reserve System get paid. But that stock is not, as I think you just mentioned, they can only have up to $25,000 worth of stock.
Yeah, I just read that in the Federal Reserve Act.
Yeah, it's not a significant portion of their profits. It's a ceremonial, legalistic exercise. It doesn't constitute any significant share of the bank's profits, of the private bank profits. So
look, I just want to say that again, because that 98% of the profits go to the U.S. Treasury. Like, how can we possibly say that's private?
Right. As a corollary By the way, as a corollary of this, people like to count the treasury bonds that are on the Fed's balance sheet as part of the US government's debt. But the interest on the debt is paid back to the government itself. So how can that be?
Let's get into that when we get into interest rates.
Yeah.
Because right after this, Mike says, hey, it's a hybrid, referring to the Federal Reserve. It's sanctioned by the government and can never have any competition, just like you said, you being Stef. It's not truly free market, obviously. It's privatized profits, not. Their balance sheets are so screwed up that one day there's going to be a big problem. He says it's highly immoral because when currency is created, it's theft. It's theft because we've traded huge portions of our lifetime for currency. So when they take part of it through inflation, they're actually taking part of your lifetime. You have to work hard to replace that lost purchasing power. It makes the purchasing power of each unit of currency smaller or less. The prices don't go up, the currency goes down. Nima, you and I just made a video on inflation. Can we rehash a few of those arguments?
Yeah, so the money that gets introduced into the private economy where it could potentially cause inflation is not injected by the Fed. It's created by private banks through private bank loans, which are made based on ability of the lender to repay the loan and the interest and considerations that are outside of the hands of the Federal Reserve.
So wait a minute, because Mike follows us up and he says it's because it being the inflation, it's because of the Federal Reserve and the fractional reserve lending, both of which are highly immoral and they're theft. So you're saying there is no fractional reserve lending?
Correct. It's a myth. It's a canard. It's a falsehood that is repeated over and over in certain circles. The banks, the private banks make loans to people that they feel are able to repay the loans. That's what it comes down to. Banks make loans to willing and able borrowers in the private sector.
Sorry, let me interrupt real quick. And when we say the bank's making a loan, it's not making a loan like you or I make a loan. It's making a loan by debiting your account out of nowhere.
Correct. The bank creates money out of nowhere, which goes to the recipient of the loan, and the bank marks a loan on its own books. And when the bank creates an account out of nowhere, that basically means the bank tells the borrower, we owe you so and so much in bank reserves or cash on demand, where the bank reserves only come into play when the borrower writes a check to a different bank and the banks need to settle amongst one another.
So because the story I remember learning, and this is connecting the Federal Reserve and the fractional reserve lending, is that because the fractional reserve lending allows the bank to lend 10 times its reserves, or let's just say 10 times. I don't know what the exact number people are saying it is. When the Fed pumps more money into these banks, they have more reserves to make more of these fractional reserve lending things happen. And what we're saying is they've got cause and effect backwards.
Exactly.
And that the way that banks work is that the first thing to understand is, just like the Federal Reserve isn't private banks aren't really that private. Their ability to create this money out of nowhere is by decree, by license from the government. They have the ability to do this.
And it clears at par with the government created money that is injected through deficit spending. Meaning, we all know when a bank can't fulfill its obligations, then the federal government will make the deposit holders of checking accounts and savings accounts up to a certain amount whole.
So when Mike is saying that the inflation, which is driving the prices up, is due to the Federal Reserve and the fractional reserve lending, it's just a complete myth. It just doesn't work that way.
Right.
The
the way the causality it works, the banks make loans, and then every month or every 2 weeks or so, they need to make sure that they have a certain reserve balance on their books. That is, in part, they need reserves to be able to service cash withdrawals and clearing when checks are written to other banks. But in part, they also need reserves just as per mandated reserve requirement, as you mentioned, 10% or
whatever the number is.
Whatever the number is.
Which, let's have a caveat. Gee, Nima, what's that number in Canada?
0.
For everybody who didn't know, there is no reserve requirement in Canada. It's 0. So
same in Europe, by the way, I think.
There you go. Well, and it makes sense because if the causality is backwards, there's no point in the bank being forced to hold these reserves.
By the way, when they changed this in Canada, when they changed the reserve requirement to 0, there were obviously lots of people on the national news predicting hyperinflation for Canada, and then that somehow didn't happen, so they were wrong again.
You're kidding. Hyperinflation didn't happen?
Yeah. So the causality is the banks create loans, and then after the fact, they may need a certain amount of reserves as per reserve requirement. And if they are short reserves, they will borrow them on the interbank lending market at the interest rate that the Federal Reserve declares every quarter or so, which is currently, I think they just hiked it to 1.75 or something like that.
Something like that, which we'll get in more of that in a minute.
So the point is, there's never a shortage of reserves. There's never a bottleneck for reserves as far as the banks are concerned. There's no bank that says, gee, I only have so and so much in reserves, so I can only make so and so much in loans. There's no loan officer that sits in an office and looks at a screen that tells them, this is how much reserves we have, this is how much you're allowed to lend. It's a myth. It doesn't exist. It doesn't work that way. The banks make loans, and then they go on the interbank lending market and they obtain reserves at the declared interest rates if they're ever short on reserves.
And the only reason they it...
Sorry, just one thing.
Yeah, go ahead.
There's no way to be short on reserves, because if that was the case, then the interbank lending rate would have to shoot up to higher levels than the Fed has declared, and that never happens. Because why does it never happen? Because the Fed always stands ready to
hand out reserves.
Yeah,
if a bank needs it.
Yeah. So what they do is actually they sell treasury bonds into the market, so that the rate into the interbank lending market, so that the rates remain constant or remain within a certain range, or they sell the bonds. If there's huge demand for reserves, they may sell some bonds. But whatever it is, they make sure that the rate never goes outside of the mandated range.
Right. And then just to reemphasize, the only reason that they have to go digging around for these reserves is because of a simple arbitrary law that tells them they have to. And it clearly doesn't have to happen because Canada does not have this law anymore, and they didn't explode. So let's move on to the next thing. We spent a lot of time on that. Stef's response to that. We're at the 4-minute mark here, by the way, of the video. So Stef says, of course, in a free market, there would be choices. And if you had the choice, would you choose a currency that would cause your savings to dissolve? He said a candy bar cost like 10 cents when he was young, and then decades later, it costs $1. Who on earth would want that as part of their currency portfolio? To which Mike responds, he says, nobody understood back in the 60s and 70s what was causing all the inflation. The people were just victims of it. And I'm assuming he's referring to the Fed printing money at this point. Now, is that why there was inflation in the 60s and 70s?
Well, I think the inflation started in the 70s. And the reason for the inflation was an oil embargo that was well known all over the world. Oil prices were hiked up significantly, and oil is a very important commodity in almost everything every good that's in the economy. There were car lines at gas stations. There was huge economic chaos all over the world, all over the Western world, as far as I'm aware. So the notion that, that people weren't aware that, there was inflation.
Or what was causing the inflation.
Right. Well, it seems like the spot price cause that we have here, in our last video, we went through several types of inflation, and in the 70s, we had clearly had a spot price inflation, which is where monopoly supplier of a good hikes up the prices for the good.
In this case, OPEC.
And that rippled through the entire economy.
And then I think, as Warren Mosler pointed out when we interviewed him, that as soon as this embargo was over, the inflation stopped.
Well, no, the inflation stopped when the U.S. started deregulating the price for natural gas, because the price for natural gas was legally fixed at a certain amount, I think whatever, $2 per unit or something. And the U.S. government lifted that fixed price, and the price for natural gas came down, and suddenly you were able to substitute, and there was competition for oil in the form of natural gas. So the inflation that they've been trying to fight by raising interest rates for I don't know how many years, and it only got accelerated more and more. It only ended when the price of natural gas was deregulated. And that's in part because raising interest rates doesn't fight inflation.
I was going to say, it sounded like you're insinuating that raising interest rates didn't really do anything.
Right.
Interesting.
Right.
Interesting. So Mike then talks about, let's see what I have written here. Mike then talks about how silly it is for one person to think that they can make decisions better than the free market can, and that this screws up pricing mechanisms, to which I can only agree with that.
Yeah. The question is he suggesting that the Fed is making pricing decisions, or what is this statement?
I think the statement is, because if we zoom out far enough and we say, okay, let's look at this in terms of free market versus state monopoly, is that because the Fed has this state monopoly on money printing, that there's one, in quotes, one person, there's a small group of people making these very large decisions, and that's the thing that's screwing up all the prices.
Well, I mean, your and my position on this, it remains the same. Yes, we agree the Fed shouldn't meddle with the interbank interest rate. If they didn't meddle with the interbank interest rate would tend towards 0%. So any rate that is above 0% is the Fed meddling and manipulating all other interest rates to higher levels than they would need to be.
Right. Then in response to this, we're now at the 6-minute mark. Stef points out that Ben Bernanke, we all know who he is, admits that the Fed had screwed things up. And this is Stef paraphrasing, I'm assuming, which is a quote from Ben Bernanke. Oh yeah, the stock market boom in the 1920s, followed by a 13-year Great Depression, followed by the deaths of 50 million people in the worst war known to mankind. Oh yeah, a lot of that was the Fed. I think it's a little bit of a stretch to say that the entire world went to war because of the Federal Reserve.
Right.
And I hear you flipping through a book, so I'll let you do that while I say this.
I just pulled out Carol Quigley's Tragedy and Hope. I just want to...
I'll pull it out, too. It's I even have the page marked 330. Or close to that.
Oh, the period of stabilization. There we have it. Okay. 1922 through 1930 was actually a period of international attempts to stabilize the currencies towards a certain level that they had declared the proper levels. So, and then
can I? Yeah, because I've read the same book. I got the thing in front of me right here. Yeah, we're geeks. Get over it. Is that prior to World War I, there was an international standard based on gold, and most countries followed it, and that essentially the amount of gold in one country would more or less buy you the same amount of goods if you went to the next country. And of course, you're speaking about the Western world here. When World War I happened, and this is one of the things that Nima and I try to point out a lot, is the reserve ratio for the gold standard, I think, went somewhere from like 30% to 10%. I'm probably off on those numbers, is in this book somewhere. So the amount of actual money in circulation in ratio to the amount of gold available went from about 30 to 10%. And after the war, for whatever reasons, the power said, we want to get back there. So this argument that the government is always trying to make decisions to increase their spending power, it doesn't sit here, because the governments were trying to say, hey, how do we get back to having 30% reserves instead of 10% reserves, and having gold parity, or not gold parity, but international exchange rates equal to what they were before.
And especially during this period, there was, it quickly refers to it as the period of financial capitalism. And financial capitalism is when owners of claims to money flows try to buy and sell those claims at a profit, basically. And he describes how it was hugely important to the banking lobbies of the time to prevent inflation from occurring. So they were completely paranoid. They were in favor of gold standard no matter what, just to retain the purchasing power of the currency that they have loaned out, to make sure that, you know, whatever they get in return is not worth less than at the time they loan it out. And they assume that the gold standard would be the way to get there. However, then we get a war and the governments do what they usually do, even when they're on the gold standard. During the war, they just change the conditions of the gold standard and do their thing. And then after the war was over, they tried to stabilize, they tried to come up with arrangements to where they could get back to pre-war parities, etc. Anyway, the point being, the US actually, as part of these stabilization efforts, the US government paid down about 1/3 of its public debt in the between 1920 and 1930. So they ran huge budget surpluses in this period. And as we've explained before, government budget surpluses drain the private sector of net private savings and lead the private sector to go in debt to the banking system and to itself as well. Stocks are an example of that. Stocks are a sort of version of private debt. And you had a stock market bubble. You had private sector actors hugely dependent on private sector loans, while drained of safe assets such as, you know, bank reserves, government bonds, etc. And so we had a very unstable level of private debt that led to the bust of 1930. So that's our interpretation of what happened in the 1920s, leading up to the Great Depression.
So, and it's kind of the core interpretation here, because as we keep saying, and we're going to keep saying it, is that every single economic crash in United States history, and there were 7 of them, have been preceded by a federal surplus. So
by a drain of net private savings.
Thank you.
To be precise.
Thank you.
Usually that's associated with a federal government surplus or a current account deficit, or a combination of the two, which was the case. The only time where this was the case was in like 2006, when we actually still had a government deficit, but a huge current account deficit, draining the US private sector of net private savings once again, leading to the crash of 2008.
So our response to Stef is that he has it completely backwards. The stock market boom of the 1920s, followed by the Great Depression of the 30s, was not because the Fed was printing money. As you pointed out, it was quite the opposite. They were destroying money, but by
and also it wasn't the Fed; it was the federal government doing that,
right? And that the thing about it leading to World War II, that's so vague. I don't know what to say to it. Do you have anything to say to that?
Well, I mean, World War II came about through psychological operations on the part of numerous intelligence agencies and on the part of actors who have goals that we can't even fathom.
Right. And then I'm part of, I would say, extreme trauma as a result from World War I, where the people were so, the remaining men who were alive had fought in the war, and they knew something was up, and they started forming incredibly extreme factions in order to deal with it. And those factions got control all over Europe. And I mean, whether or not the Fed's printing money back in America, it kind of seems like this vague moon orbiting way off in the distance.
It was a 30-year war, essentially. It was another European 30-year war with a minor interruption.
Yeah.
Started in 1914, and ended in 1944 or something like that. 45. It's literally 30 years, basically. Yeah.
So now Mike agrees with Stef. We're a little after 7 minutes. That the Fed's actions in the 1920s caused the Great Depression, as we just refuted. Then he says, this will be nothing compared to what's coming. The manipulations that led to the Great Depression were minor compared to the 0% interest rates and the more than $3 trillion of currency creation. We're getting into the realm of fun. Nima, tell me about the horror of 0% interest rates.
Well, so bank reserves are injected into the banking system when the federal government spends money and doesn't tax it out of the system. This money is used by banks to leverage private sector loans, not in the sense that it's fractional reserve banking, but rather when people do interbank clearing, when banks do interbank clearing, they will draw on those reserves from each other. If the Federal Reserve left the interbank market alone, the interest rate for reserve loans would be 0% or close to it. So anything the Federal Reserve does, that's anything
rate, other than zero,
anything higher than zero,
or even less than zero, right?
Even less than zero, yeah, is an intervention in the interbank lending market.
So, yeah, the interbank reserves are naturally zero, and anything other than zero is the Federal Reserve messing with stuff. So, I recently did a debate with Bob Murphy on this subject, and I've heard Bob Murphy, Austrian economist, bring this up several times about the Federal Reserve artificially pushing down interest rates.
Yeah.
The Fed can't artificially push them down. They can only artificially push them up. When they stop pushing them up, they just fall to zero. And I think the proof that we could see in this is, as you said, the interbank lending rate is never more than the Fed Treasury bond interest rate. Because the way that a bank makes money is the difference between whatever the federal interest rate is and whatever interest that they're charging you. And if they were to charge, let's say that the federal interest was 3%. It would make no sense for a bank to make a loan to me at 2% when they could just turn around and sit their money at the Fed for 3%. So whatever the Fed interest rate is, that represents the minimum that a bank can earn doing nothing. And so any extension beyond that is how what they're going to charge you. And so what that means is if there was no Fed rate, they wouldn't have to go in between the Fed rate and their profit. It would just be between zero and their profit. So what do 0% interest rates do then? If they're not this big, scary monster?
They basically return the interbank lending market to a state of no intervention.
Oh, so it's less government.
It actually is. Yeah, I mean, it's where the market would be if the Fed hadn't intervened in the first place. But in any case, what does the Federal Reserve rate do? In any case, it offers free risk-free money to people who already have money. That's all it does. And through that mechanism, it manipulates the term structure of all loans, because as you just pointed out, all private sector loans will add their risk premium on top of the risk-free rate. That's what happens. And according to Warren Mosler and mathematics, it actually injects more money into the system than it pulls out.
High interest rates do.
When the Fed hikes the interest rates, they're actually injecting net more money into the system than they're taking out.
And the reason for that is because, as we've gone over, and we just have to keep hammering this point over and over again, the Fed or the government, it doesn't matter who's paying for it, does not pay for matured bonds by taking tax dollars or by selling more bonds. It's not like that there's some, I like Warren Mosler's imagery, there's not like that there's some guy at the Federal Reserve running around with a wheelbarrow full of cash, bringing it to the Treasury or bringing it to the Fed or paying this guy off or paying that or whatever. All they do is, if you have an account of treasuries and they mature, the Fed, I mean, it's a computer doing it automatically, obviously, but the Fed goes in and they type a new number into your account and bloop, that number comes out of nowhere. They didn't take it from anyone else. And this is a perfect opportunity to point out the government spending is not constrained by taxation. The government spending is not constrained by taxation. The government does not take your tax dollars and then turn around and spend them on something else. They take the tax dollars, they get destroyed into oblivion, and then when they want to spend something, they snap their fingers and out of oblivion come tax dollars and they spend it on it. So let's look at the second half of his sentence. He said, the manipulations that led to the Great Depression were minor compared to the 0% interest rates and the more than $3 trillion of currency creation. I'm guessing he's referring to quantitative easing here.
Right. When quantitative easing is really just a very benign shifting of the net money supply from higher interest paying assets to lower interest paying assets. It's essentially paying off some savers, some bondholders with a little premium that makes them want to sell their bonds. And it gives them bank reserves in return. And then what do they do with those bank reserves? Well, they were saving money in very safe and very conservative assets. So what are they going to do with the new money? They're just going to leave it there or put it in new bonds or something like that.
Yeah. So let's paint that picture a little bit better. So remember, when quantitative easing is when the Federal Reserve creates reserves. And when we say reserves, it means it's essentially cash. This is the cash that you could pull out of your bank account. That's what a reserve is. It creates reserves out of nothing, and it goes to people holding bonds and says, hey, with the reserves that we have right now that we just created out of nothing, we will exchange them for your bonds at a little higher rate than what you would have gotten paid anyway. And everyone raises their hands and screams, oh my God, the Federal Reserve just printed more money. But bonds are money just as much as reserves are. They just pay you a little bit different interest. The only difference is the reserves are like money in your checking account. They don't pay you any interest, or they pay you very little interest. And Treasury bonds are like money in a savings account. It pays you a little bit better interest. And so all quantitative easing is doing is shifting money back and forth between savings and checking accounts. That's it.
Exactly.
So I got that right?
Exactly.
So when we're jumping up and down saying, okay, the Fed's printing money, the Fed's printing money, the Fed's printing money, economic doom's around the corner because the Fed is moving money from savings accounts to checking accounts. That's how stupid it is.
Yeah. Plus, on top of that, we just explained that even the Depression of 1929 was not created by any such mechanism. It was created by government budget surpluses.
Well,
because we started discussing this point, because Maloney said this time it's so much worse than 1929 because of the QE. But first of all, 1929 had nothing to do with the Fed shifting money between checking and savings, had nothing to do with QE, had nothing to do with money printing. It had everything to do with the government running a budget surplus, and the private sector going in excessive debt to the banks and to itself.
Well, Mike says that this is the greatest manipulation of an economy that there's ever been in history. Yeah, I don't know what to say to that either.
Well, I mean, so we're not saying that 1929 cannot possibly happen again, but the conditions would have to be such that we're starting to deprive the private sector of net private savings. That would require a ballooning current account deficit, or the government running smaller and smaller budget deficits, or maybe even big government, or maybe even budget surpluses.
Which is the opposite of what's happening right now.
Exactly.
Let's actually go over real quick what's happening right now. There's three big things that the Trump administration has done. The first one is the tax law. All the taxes got cut, particularly the corporate taxes. So that's increasing the deficit right there. Second, the only thing that Trump has agreed with on the Democrats and met with Nancy Pelosi about this was to increase the debt ceiling to fix Puerto Rico.
Infrastructure spending also, by the way.
Thank you. Well, yeah, the third one I was going to say is he has increased the spending a little bit. Actually, no, that wasn't the third one. Thank you. That would be a fourth one. The third one is the tariffs. Now, personally, I think Trump is using that as a foreign policy maneuver. But regardless, if we could prop up tariffs, and we're successful in, say, producing steel here and producing aluminum here, what that means is we're going to stop importing steel and aluminum, which means we're going to stop exporting so much dollars.
Well, the discussion about tariffs is complicated, because
right.
There's a whole bunch of a whole chain of events that is put into effect there. It's possible that you're right in what you're saying, just because the U.S. capacity is so underutilized, where it's like 70% capacity utilization, and there have been unfair trade deals. So maybe, but to your point, maybe those tariffs will boost domestic investment. But another big factor is that the Trump administration is lifting restrictions on private investment left and right when it comes to unscientific, stupid environmental regulations that are trying to reduce the amount of CO2 output, because there are some crazy people out there suggesting that CO2 makes the weather dangerous.
Stop breathing.
And breathing
making
also.
The weather dangerous.
So we're nixing completely phony, unscientific regulations that exist for no reason other than restricting investment spending. And we're setting the private sector free, potentially, to do much more investment spending in the energy sector. So that's another big counter to the possible the prophecies of gloom and doom, because that's a private sector spending that was prohibited before by government decree, that in particular investment spending.
So yeah, let's zoom out on everything that we just said. So the idea here that's being pushed is that the doom of the dollar is coming, and you and I are not saying that that's impossible. What we're saying is, let's look at what would actually lead to that. And not only are we not seeing it, we're seeing the opposite.
Yeah.
We're seeing a stronger economy emerge.
Yeah. So we would have to see a reversal on all these economic trends we just pointed out, or a huge wildcard event that obviously, let's say China and Russia and North Korea band together and conduct an EMP attack. I don't know if you've heard of EMP, but I've heard.
I know what it is. Yeah,
electromagnetic pulse attack on the entire U.S. economy,
and it shuts the whole thing off.
Yeah, that'll make people panic, and that'll certainly have some sort of effect on markets. Those kinds of events, we're not saying that gloom and doom can't happen. If an EMP attack happens, certainly the gold price will shoot up like crazy. Or if something comparable happens, civil war breaks out, that'll be good for gold, but not the Fed shifting some savings and checking account money from one place to another.
Right. Okay. So Mike goes on and he points out the correlation between money being pumped into Wall Street and the stock market going up at the same time, and he refers to this as a fake recovery.
Yeah, there is no money being pumped into Wall. Any one of these people, describe the mechanism, how money is being pumped into Wall Street, please.
I forgot the video only looks at me when I say something. So now that it's looking at me, I did this.
Right.
Okay. So we're at minute 9:40. Stef, let's see. He starts talking about the welfare state.
Well, let me just hit that point. Money being pumped into Wall Street. Because I just want to give people who are really interested in the correlation between interest rates and Wall Street some helpful info here. There is a correlation between the interest rate, the risk-free interest rate that the Federal Reserve declares and prices on Wall Street. But it has nothing to do with the Fed pumping money into the stock market, because the Fed doesn't pump money into the stock market. Private investors pump money into the stock market. People who buy stocks pump money into the stock market. That should be obvious, right? I mean,
yeah, well, and then let me go further from that. I have never understood why I really care about the stock market. I mean, I understand if it all goes to zero, all those companies went out of business, and that's a problem. But like, if the stock market goes up and down 20 or 30%, like, I got a business where I clean up properties.
Well, let me.
How the hell would that affect me?
Let me answer that. You know, if the economy gets to a point where the private sector is indebted a lot to itself, you know, like, for example, the 1920s or prior to 2008, any time when the government happens to be running a large budget surplus, then that means that a lot of people have stocks in their portfolios, among other things. So that means that stock prices crashing has an effect on people's net worth, and that in turn has an effect on people's spending, and people's spending has an effect on production, and production has an effect on how many people companies hire, and how many people companies hire has an effect on how much wages they pay. And so it's a circular effect. If stocks crash disastrously and people stop spending, then you'll have a ripple effect from there that can lead to recession or depression. In a situation where the private sector has hugely gotten in debt to itself. But let me just get to the point that I was going to make. The correlation between the Fed's interest rates and the stock market are only in the sense that the Fed sets the risk-free rate, and an investor who buys a stock uses the risk-free rate to calculate the net present value of the stock. Because the net present value is the value of all future expected cash flows discounted by the risk-free rate. So yes, if the rate goes to zero, then certainly that's going to be a boost to stock prices, all else being equal. But it's only in the sense that the price was artificially held down previously because the Fed was manipulating prices up.
So you're saying if the interest rate on the bonds are artificially high, I might put my money into bonds instead of stocks.
Exactly. It's not just you might, that's exactly the mechanism that occurs.
Right. And then the bonds are risk-free. The stocks, I can lose everything.
Yes.
Okay, I'm going to move on. So at 9:40, Stef starts talking about the welfare state and how it's a transfer of money to the poor. He also then brings up the opposite welfare state, and I think you were hitting on this a little bit, where Wall Street and the politicians and whoever else close to the Fed get to suck off the lower classes using the current system. If you're poor, they're cranking out a lot of money, and it's just evaporating in your bank account. But while you're thinking, here's the one thing I want to say, and I got this from you, which is when you have a high risk-free interest rate, when the Fed pumps up rates, what that's about the only thing that's really doing is making a basic income opportunity for the rich. Yeah. So if I already have $20 million and I stick it in a 2% bond, that's a pretty good return. I can live off of that quite handsomely. If I don't have $20 million, I can't really get a good return out of that. And so to drop the interest rate to zero makes that opportunity go away for rich people to get free money.
Right. And giving rich people the opportunity to earn risk-free money can actually be inflationary, because you're giving people with a lot of money more money,
and they produce nothing for it.
Produce nothing. So if they spend it, that's actually on its face inflationary.
Okay,
also,
so can I jump up and down and yell that really quick?
Yeah.
We are saying that increasing the Fed rate is inflationary, not deflationary, and that decreasing it is inflationary. No, excuse me, deflationary, not inflationary. Because, as we went over, the Fed's ability to pay out bonds has nothing to do with them taking taxes or selling more bonds. So the cause and effect, most people think, and this is what I was taught under the Austrian system, and it's partially true under a fixed exchange rate, which we don't have, is that when the government raises rates, what that's signifying to markets is that the government is losing control over its spending, and it's losing control over its policy, and it's desperate to get your money to pay for stuff now. And it's raising the rate in order to say, okay, hey, we'll give you 6% instead of 2%. Just give me your money. Just give me your cash. Just give me your cash so I can pay for this stupid project that I passed. Where, as we just said, in reality, that's completely not true. All they do is they just mark it up in your account. And so if the only accounts that you're marking up are for rich people who get the opportunity to have that basic income, well, they're getting free money. And if they, like you said, if they spend it, they didn't produce anything to get it, so it's naturally inflationary.
Right. And also, I just want to point out something to this whole idea that, back 100 years ago, a candy bar only cost 10 cents, and now it costs $1. Yeah, but if you'd kept money in a standard savings account, then your money would have probably grown by the same amount, maybe a little bit less, maybe even a little bit more, who knows. Generally, just so happens that the rates that the banks pay out to savers have to account for inflation to a degree, at least for the sort of standard consumer price inflation. So if you'd left your money in an account, it would have accumulated accordingly. So this whole idea that people's savings are evaporating, the exact opposite is the case. Your savings are accumulating, not evaporating.
Mike then points out here, I think this is the high velocity money argument. The first users of the currency get the most benefit and everybody gets punished. The argument being because I get to spend the first users get to spend the money at the pre-inflated rate, and then everybody else gets it bounced around and they get to spend at the lower rate.
Well, also, who's the first user? So now we've just completely blurred everything. Stef asks Mike to clarify how printing money. We've already explained that the Fed doesn't print money or inject money into the private economy anyways. So I think they're just going off on this whole fallacy that is wrong to begin with. Or what are you?
Yeah, so I'm trying to connect this to a personal example of mine. So I mentioned my property cleanup business. I recently cleaned up a property for HUD, the Housing and Urban Development, which means I got paid with federal money. So naturally, what me and my business partner did as soon as we realized it was HUD is we said, how can we charge as much money as we possibly can? Because that's just the nature of government contracts. Because particularly now that I know about MMT, there's infinite amount of money that could fall from the sky on me. So that was money that was created out of nowhere. Now, are we saying that the money that fell on my business that me and my partner paid ourselves with, was I the first user of that currency?
Yeah. I'd say, well, technically the government was the first user.
Yeah, when it hit me.
But then there may be some truth to this thing. If we are in a full employment economy, if we are in an economy where the free market has been allowed to spend and produce without overtaxation, then new government spending means by necessity it has to compete with the private sector. But if we are in an economy where the government has declared
underutilized resources,
the government has declared an excessive tax, and now spends too little money into existence, that means people will certain number of people hold on to their money more than they normally would if they weren't so overtaxed, such that no private spending occurs and then no investment spending occurs. And then you have idle resources that are unutilized. So if we get to a point where the deficits get so large, we have a private sector full employment, which we're not even near close to, by the way, right now. All the numbers are lies and misleading that are published by the government.
You mean regarding unemployment?
Regarding unemployment. But we could get to a point where we have inflation. Same goes for bank lending. As we've explained before, bank lending can lead to some inflation. And this whole process of the first users get the benefit, yeah, that may be the case, but it may also be deserved. Because if you're an entrepreneur who gets a loan, takes risk, and prices his products, and the project is successful, then it means your prices are at a certain markup over wages, and your the benefits of the inflation accrue to you first and foremost. But it's also you're the entrepreneur, took the risk, et cetera, and it's also not overwhelmingly large inflation. It's just the type of inflation that distributes income among workers and capitalists inside the economy. On the same token, could happen that the workers, through successful wage bargaining, push up their wages, and then that leads to inflation, which in turn means that income is shifted from unskilled labor to skilled unionized labor, et cetera, et cetera. So these effects may occur. They're certainly interesting to study, but there's more to it than Fed prints money. And
yeah, and then even in my case, I didn't get paid by the federal government because the Fed printed money. I got paid by HUD because Congress gave it funding.
Right. But the Fed printing money is always goes back to that type of money creation is not really money creation. It's just shifting funds,
savings and checking account,
between savings and checking account, or a high interest checking account to a slightly lower interest checking account.
So going to the next thing, Stef asked this question. He says, "Okay, the Fed creates money, then where does it go?" We kind of just went over that. But Mike gives a diatribe that I have no idea how to unpack. So I tried to write it down verbatim. So I'm going to start reading, Nima, and you tell me when you want me to, because it's long. It's a big paragraph. You tell me when to stop, and we'll go over that.
Yeah.
Sound good?
Yeah.
Okay. So this is quoting Mike Maloney, responding to Stef. Well, when the Fed prints currency, that's base currency. It's paper dollars that exist or the deposits that commercial banks have at the Federal Reserve.
That's correct so far. Mm-hmm.
The Federal Reserve is the bank of the commercial banks. Mm-hmm. There's 28 primary dealers, which are the commercial banks that are allowed to show up to the Treasury auctions. They buy bonds from the government through the open market operations. If the Fed wants to stimulate the economy, they force banks to sell them bonds at a profit, so the banks love it. But now,
let me unpack that. If the Fed wants to stimulate the economy, so the Fed forces the banks to sell them bonds. So the Fed buys bonds from the banks. They don't force them. They just go on the open market and buy bonds from them.
They offer a profit, and the banks are like, "Of course, I'll sell you. Give me more than I was going to get anyway."
Mm-hmm. Yeah, so that's exactly the mechanism that we talked about earlier, where the Fed takes the savings account and turns it into a checking account, right? They take a bond investor's bond and replace it with cash. Let's just say cash for simplicity's sake. Mm-hmm. Okay. So the banks love it, okay? Because there's a slight profit, because when the Fed goes into the market, which is, by the way, I think it's a multi-trillion-dollar market. So the Fed buys some bonds there that may push up the bond prices a little bit. And the banks love that tiny profit they get. Okay. Well, go on.
Sure. All right. So, if the Fed wants to stimulate the economy, they force the banks to sell them bonds at a profit, so the banks love it. But now an asset has been pulled off their balance sheet, and on a bank's balance sheet, cash is a liability. So a liability has been added and their balance sheet looks worse. So when the banks have a bunch of cash they want to get rid of and create loans. Let me read this again. So a liability has been added and their balance sheet looks worse. So when the banks...
Sorry to interrupt. So that's not true. An asset has been pulled off their balance sheet and cash is a liability. The cash is a liability for the Federal Reserve, but not for the private bank. For the private bank, all that happened is that they've swapped an interest-bearing asset against a non-interest-bearing asset.
But they're both assets.
They're both assets. It would be stupid to replace an asset with... Who would do that? What kind of thinking is that? They're replacing a high interest-paying asset with a lower interest-paying asset. So it's not a liability, but okay, let's move on.
And then he says, so when the banks have a bunch of cash, they want to get rid of it and create loans, supposedly. This goes back to the fractional reserve thing.
Yeah, no,
they don't. They don't care.
They can't, actually. They can't get rid of the cash by making loans. That's factually impossible because the only thing they can do to get rid of the cash is they can buy government bonds. So that would be, they would go back from the non-interest bearing asset and then buy another bond with that cash. That's a possibility. I don't know what the big drama is about, but that's a possibility. But the bank doesn't make loans because it has more bank reserves on the balance sheet. 2008, by the way, made this very obvious to anyone who paid attention because the banks ran up huge excess reserves and didn't loan out more. The banks make loans when they have a willing and able borrower. It's almost like the Bart Simpson on the chalkboard. That line, we just have to make Stef and Mike Maloney write that line over and over. Banks make loans when they find willing and able borrowers. Banks make loans when they find willing and able borrowers. They don't care how much cash or bank reserves they have on their balance sheet. And the only people who say this stuff is people who never went to a banker or to people who know about banking to ask what's going on. How does this work?
Okay, I'm moving on. When they create loans, they have to compete and offer lower interest rates, and that indirectly stimulates the economy. I think you just hammered at this.
Yeah, but that's what they do all the time. They make loans to willing and able borrowers.
Yeah, but he's saying that by increasing the reserves, that increases the amount of loans that they're making.
Yeah,
which you just took out. And then he follows us up by saying, so the Fed does the shell game that sort of indirectly stimulates the economy by encouraging the banks to compete to create loans. Wrong. Just factually incorrect.
Yeah.
But it's always the first users, and a lot of these banks are like Goldman Sachs and stuff. They're big brokerage houses. And they got their own accounts that they're trading on Wall Street, so now they have a bunch of extra cash that can be used for margin lending.
Well, they don't.
How do you respond to that?
They don't loan out their bank reserves. Once again, they make loans when they find willing and able borrowers. They make those loans out of nowhere. The amount of cash or bank reserves on their balance sheet doesn't factor into this.
And then the margin lending thing. If they've got treasury bonds, and if they wanted to sell those treasury bonds and then do margin lending, they could just do that. The Fed doesn't need to come in and QE them into that situation, does it?
They make margin loans
regardless.
Find willing and able margin borrowers. And whether or not we allow the banks to make these kinds of margin loans is a matter of bank regulation. So the Fed does indeed have some say in this, but it's not in the form of buying and selling assets. It's rather in the form of establishing regulations for the banks that they have deployed all over the countries to do the government's lending for them. As we said earlier, private banks are essentially public-private partnerships. But if they wanted to restrict margin lending or whatever it is, they would have to do that through bank regulation. Is my main point. Sorry. Good.
No, I'm just getting myself ready for the next thing. So they get the basis for a whole bunch of leverage to go into the stock market. this is going back to what he said about the stock market, is this quantitative easing is giving them the reserves to do the margin lending to artificially prop up the stock market. Just untrue.
No, I mean, in fact, actually, Randy Ray, I think in the book that you read,
Modern Money Theory for everybody.
Yeah, he explains how that story that economists tell themselves about how buying government bonds gives the bank excess reserves that they have to loan out. That whole mechanism can't exist because the newly created reserves would immediately collapse the interbank lending rate to zero. So there's no such. This is all fiction, basically. This is all fiction by people who don't
go into banks.
Who are not interested in how banking works. Yeah.
So not only does it dilute the currency supply, they get a full purchasing power of it because of the first user of it. We talked about that. It dilutes the currency supply after this new currency enters circulation, and that lowers the purchasing power of everyone. So that's where the purchasing power comes from. It was stolen from everybody else by lowering their purchasing power. It was a gift to these big banks so they can take that stolen purchasing power and gamble with it on the stock market and win an even greater share of the economy from you.
Yeah.
I mean, after what we just broke down, all of that was just like, how many non sequiturs can you mix in a bag?
Yeah, I mean, it's just piling falsehoods on top of falsehoods. So I think we've already.
I think we've got that. Okay, we made it through the big paragraph. Whew. All right. So right after that, let's see. Stef, we're at 1350. Stef reaffirms how terrible that is. They talk about stocks for a while. And then at 19, he brings up, Doom Tourette's.
Right.
And so Stef acknowledges that they keep crying doom and doom isn't happening. And I don't remember where it was. Mike at some point says, I think it's going to happen within the next year or two.
Right.
Here's my response to this is it's like, okay, we're 10 years after the last crash where everyone's like, there's going to be a bigger one. It's going to be worse. It's going to be
I like how he says we tend to be right once or twice a decade.
So if you zoom out far enough and you could make the basic observation, crashes happen eventually.
Well, but basically what all he's admitting is that a broken clock is right.
That's exactly what I wanted to say. Thank you.
I mean, so what he's saying is, we hammer gloom and doom. Once in a while, there's actually some crisis that happens, so we happen to be right. Well, good job.
Yeah. Mike continues. The longer this goes on, the worse the reaction is going to be. The economy is a closed system. Keynesians think you could stick a straw into outer space and suck in economic energy. You can't. You can transfer it from one sector to another, and that's about it. So, the thing that popped into my head is if we compare pre-civilization Earth to post-industrial Earth, if you can only move stuff from one sector to another, where did all this industry come from?
Investment spending.
And where did investment spending come from?
Bank loans. And
those came from government regulations.
I mean, there's several stages that capitalism has gone through to get to the point where you can do investment spending. I guess, old Greeks and Romans also had it, right? But then for a long time, there was just stagnation all over the Western. I guess we're looking at it from a Western focus usually. Then,
and sorry guys, that's the important focus.
Right. When I think in 900 or 1000 AD is when commercial capitalism began, which meant that people started traveling around the world and exchanging crappy goods for
slightly less crappy goods.
For like really interesting exotic stuff. That was the first phase of capitalism. And then we went from commercial capitalism, which was really just global, trading by government chartered corporations who went to other continents, to barter, or not barter, but to bargain for better goods,
or conquer for better goods.
And then at one point we came to the stage of industrial capitalism, which required for some people to be employed in a sector that doesn't immediately churn out, whatever textiles or foods stuffs, but rather machinery that would be used by other businesses rather than by consumers. And so to mobilize resources to do these kinds of things, governments and the banks that they chartered started making loans, which is essentially assigning preliminary spending points to a willing and able entrepreneur who could then mobilize resources to build the machinery and then sell them to other businesses so they could produce at better worker productivity. And that's what we call economic growth, is to mobilize resources towards the investment goods sector to produce machinery and computers and things like that. Now, why do we do this? Honestly, we talked about this the other day. I started looking big picture at this a little more, but not really a topic right now. But it's just a matter of fact as to how civilization has been progressing for the millennia that we're aware of. It's been growing and increasing our standards of living by increasing the amount of industrial goods per worker to increase worker productivity.
Yeah, and then I also want to address, because he brought up Keynesianism. And to be fair, I mean, I used to say this stuff too, and that I see where they're coming from, because there's this idea that you creating a abstraction that's merely a digital ledger isn't the same thing as creating a real good or service. Obviously, very clearly, yes. However, the point is, if that digital ledger is what you need to participate in the economy, and there's not enough digital ledgers to go around for everybody to participate, if you increase the digital ledgers, more and more people get to start participating until everybody's participating, like we said. After you hit that, now we can start talking about inflation from too many ledgers. Right?
Right. And, I mean, at least he's talking about Keynesians. We're not saying that you can stick a straw into outer space and suck in economic energy. We're saying that we want to lift the restrictions of the private sector to allow it to do the spending and capital development that it needs to grow. So we're not.
And one of those restrictions is not enough money.
No, it's taxation. It's taxation. Well, yeah, ultimately it comes down to the taxation takes away people's money.
Right.
So yeah, we're overtaxed is our main point.
Mm-hmm. He goes on, Maloney. When the free market overwhelms the manipulations and balances everything, it's going to be very painful for most people. It's going to hurt certain people because there's always a wealth transfer. I think he's referring to the invisible hand here. What do you think?
He's saying there's going to be a big crash, and
that the free market's gonna like take over what's going on.
Well, yeah, because classical economic-minded people or Austrian economics people, they always think there's a bubble due to a misallocation of resources. Because, first of all, any interest rate that the Federal Reserve makes is too low to them, and so it's lower than it would be on the free market. So that leads to misallocations of resources.
Which, as we've gone over, is the opposite.
Yeah, and the misallocation has to be liquidated. And that liquidation is what he's referring to. And, he's a big gold and silver investor. So I think what he's also, underhandedly saying is all the people who listened to me and bought gold will
be very happy.
Right. They'll be profiting hugely one day.
Stef says something very strange, I find, in response to this, because he moves on to cryptocurrency, which is an excellent thing to talk about in this conversation. We're at 22:35. He says, Fiat currency is unlimited in its production. Cryptocurrency is not. How is cryptocurrency not limited in its production? People are making them left and right.
Well, but any particular given cryptocurrency, depending on which ones we're looking at.
Yeah, depending on which ones we're looking at, right? I can make a cryptocurrency that has no limit on its production.
Well, Bitcoin, there will never be more than 21 million Bitcoin units. Ethereum will actually grow for eternity, from what I understand. However, the increase is determined via algorithm. So I think maybe just to be gratuitous towards Stef's argument here, if it is one, maybe he's saying that fiat currency is the increase in fiat currency is up to the arbitrary whims of the government, whereas cryptocurrency, with cryptocurrency, it's not. It's up to an agreed upon algorithm.
Right. Well, I would say it's up to the arbitrary whims of the private sector. Right. You and I could come up with any sort of algorithm for any sort of cryptocurrency we feel like. But I mean, I guess we're splitting hairs at this point. Doesn't matter. Stef then asks, which we'll have to try to figure out what he means here. What was fixed in 2000 I wrote in and after. What was fixed after 2007 that justifies any type of continued expansion? What do you think he means here?
Well, because he's asking, so if everything's just the same as it was leading up to 2008, then why do we keep on seeing economic expansion? Why would we see one down the road? Well, like we said, first of all, leading up to 2008, 2007, we had private sector net saving going negative. That was fixed afterwards, and we still don't have that problem. So that's one thing. The other thing is, as far as I'm aware, you know more about real estate, but as far as I'm aware, after the real estate crisis of 2008, banking regulations essentially did away with so-called liar loans, which was at the peak of, I think I watched a TED talk on this by a guy who used to be in the SEC, and he said that at the peak, I think it was in 2006, in the year 2006, something like 70%, maybe even more, of all home loans were liar loans, which is loans where the borrower just claims that he's making a certain amount of money and then gets a loan.
And then the bank doesn't say, show me your income statement, show me your last 2 years of tax returns, show me that you didn't just pull your down payment off of a credit card.
Right.
That sort of thing.
I think this particular aspect, which was a huge aspect,
isn't there.
Has been fixed at the time. Now, as Minsky says, the private sector always innovates around these types of regulations. I'm not aware that it has yet in this case.
Well, I was talking to a real estate agent looking for properties, and she said she's starting to notice that people are doing the I got my down payment with a credit card thing again. Now, I don't know how widespread this is, and I don't know the impact it's going to be, because even if people are doing that, that's a hell of a lot different from like the way that mortgage brokers were just like, here are the mortgages, woo, subprime, everything. I've actually spoken to, I'm in this real estate investor group, and many of these people in this group were were mortgage brokers before the crash. And they're all just like, yeah, I didn't have any idea what I was doing. I was just like, sign here. And
well, it's like in that movie, Big Short, where they were like, we're loaning to strippers and he
didn't even speak English. I didn't check for anything. Why would I care?
Because they just sell the loan to mortgage-backed security investors, essentially. So this goes back to the private sector going in debt to itself.
Exactly.
When the government runs a surplus, or when the private sector is drained of net savings, then the private sector starts going in debt to itself and starts innovating, creating all these instruments, and mortgage-backed securities were one example of precisely what we keep on trying to hammer here.
Well, and let me bring in some real estate knowledge. So one of the big things that has been pushed since the 2008 crash is people using retirement accounts for real estate deals. So unbeknownst to many people, retirement accounts like 401ks and IRAs, you can almost invest them in anything. There's literally three things you're not allowed to invest a retirement account in. It's life insurance, shares of an S corporation, and collectibles. You can literally invest in everything else. And your company will have an agreement where it says, okay, our company policy is we only invest in these stocks and bonds or whatever. But if you do a self-directed, you can invest in anything. And so once the bank money was turned off and all these investors are going, where am I going to get my money from? They looked at the law and said, hey, if you roll over your IRA to a self-directed IRA, we could set up an LLC within that IRA, and then you can lend me the money, and then I'll pay your IRA a profit. And then now I'm working with you as the lender and instead of a bank. And now people, for example, are able to use that and say in the Seattle market where you need like $1 million to flip a fucking house. And it's hard to find someone with $1 million in their IRA. You could take that as a down payment for a hard money loan to go flip your house. So yeah, I mean it's all about how can.
I think you're talking about that thing where you're allowed to do early distributions from your IRA without.
No, I'm not talking about that. I'm saying that your IRA is allowed to invest in real estate, okay. and your IRA is actually becomes the owner of that real estate.
Okay, interesting.
Yeah, it's another long-standing applause for our educational system for teaching us how to use our publicly available tools. Anyway, I'll move on. So we talked about response to Stef. He said, what was fixed in 2007 that justifies any continued expansion? Here's Maloney's response. He says, nothing is fixed. Nothing is different. We don't have the huge mortgage-backed security bubble with all the subprimes. That's about it, as we just mentioned.
So there's something.
Yeah. A big something. Otherwise, everything else is worse. 2008 is just the first half of the hurricane, and the second half is going to be much worse than what happened in 2008. And then here's where some gold comes out. The proof that we're still in an emergency is that there are countries that still have negative interest rates around the world. After the global financial crisis, the Fed is still at an extraordinary low interest rate. When the 2008 crisis happened, they had 5% to work with, and they cut it down to 0.25%. So the Fed interest rate was at 5% now, and then they brought it down to 0.25%. Now it's back up to 1.5 or 1.75 or whatever. And they created $3.2 trillion of base currency. Now they've got $4 trillion of base currency out there. Plus, I think the interest rates are, he mentions that they're higher. Where do you go from here except negative? Now, if you're listening to what we've said so far, the interest rate is not a useful metric for measuring when the next global financial crisis is going to occur.
The interest rate alone isn't correct. I mean, if we're going to look at things like the yield curve inverting, that tends to be an interesting input in a comprehensive analysis. But there's nothing here that's evidence of a coming crisis. The interest rates now are 1.75 or 2%. Where do we go except negative? Well, how about we go to zero? Even if
or up. I mean, that's all they've ever done is they just pick a number.
Well, I mean, when the crisis occurs, because they think the interest rate matters, because they think the interest rate can help stimulate the economy, they will then drop it to zero. It's not going to do anything.
And it actually unstimulates the economy a little bit because less money is being introduced into the economy.
Right.
And then again, to address this 3.2 or $4 trillion of base currency that's created. No, it was not base currency that was created. It was just switching from a savings account, which is known as a treasury bond, to a checking account, which is known as reserves or cash.
It's commonly referred to as base money. So that's what he's referring to. That bank reserves, they're called base money, but they're really just the bank's money that they have in the checking account that they hold at the Federal Reserve Bank. So in any case, it doesn't hit the private economy. It's an irrelevant number. It doesn't create inflation.
The negative interest rates. Let's look at Japan, and then let's look at what Stef said in response, because he mentioned negative interest rates. He says, negative interest rates are when your money is so crappy you have to pay people to take it. Isn't that the opposite of what happens with negative interest rates?
Right. Interest rates means the money is so good, you want it even at a negative rate.
Pay to take it. In private conversation, we've talked about in Japan, they have a negative interest rate right now, and if you have a savings account, you pay interest to have that savings account.
Yeah, you buy a 10-year bond, you get less back at the end. You pay money,
and you want to buy the bond because you get less back than you would in the savings account.
You get a higher rate than at your savings account. And then if you get a 30-year bond, you may actually get a positive rate of 0.5% or something like that. And then they have 50-year bonds as well. So that's then even higher than that. But just to give people an understanding, why do people buy these securities? Well, there are institutions out there that need these kinds of securities, statutory or as a matter of portfolio strategy for several reasons. They need these securities, and it's a relative choice, right? It's as Stef likes to say, compared to what are we making this choice?
And then let's talk about Japan for a second. So Japan's had negative interest rates for a while now, and according to our interest rate metric, that low interest rates are going to overstimulate the economy, create a bubble, and eventually cause a crash. We haven't seen this crash come out of Japan yet. And in fact, Japan has been trying to inflate its money, and the economy, the money's not getting inflated, and the economy is not getting stimulated.
Right. In fact, as we said earlier, if having positive interest rates injects more money in the economy, then having negative rates actually pulls it out. So, that may be a part of the reason. I mean, there's a lot of things to cover when it comes to Japan, and I'm not an expert on it, but that may be part of the reason why Japan is still sort of going through a prolonged deflation, or at least slipping in and out of deflation.
Right. So the conversation then kind of drifts off, and they get talking about cryptocurrency and philosophy and AI. It's not relevant to our conversation. And then at 34:40, Stef comes back and he says, okay, let's talk about bubbles. He brings up the auto loan bubble, and he brings up the student loan bubble, and then criticizes the worthlessness of the educational system and asks Mike Maloney if he sees any other ones. Now, the first thing I want to say, actually, the zeroth thing I want to say before I say my first thing, is that I totally agree that the educational system is beyond worthless. That talk about a waste of money and putting people into serious debt bondage for their whole lives that they can't get out of for literally nothing useful. But when he compares the auto loan bubble to the student loan bubble, this is really an apples and oranges situation. The auto loan bubble is the private sector indebted to itself. The student loan bubble is the private sector indebted to the government. Completely different worlds. Can you hit on that again?
They're comparable because being indebted to banks, I mean, essentially the student loan bubble is being indebted to banks. And as we said earlier, the banks are just public-private partnerships. So maybe it's a little more public because it's the Fannie and Freddie Mae and stuff. But in principle, it's not hugely different. And actually, in actuality, it could be argued that this is even worse. I mean, from the standpoint of the borrowers, it's worse. But from the standpoint of those holding the assets, the loans, in other words, holding the students' lives hostage, from their standpoint, it's much better because these loans cannot be bankrupted on easily, at least.
Mm-hmm.
So
just for the record,
the bubble pop in student loans because they can't be discharged. There can't be any bankruptcy in student loans.
Just for the record, I am for student debt forgiveness as long as it's immediately followed by no more free ride student loans, where you just get a loan for no reason whatsoever. I think that is one way that the government can come out and apologizing for promoting such worthless crap that leads to debt bondage for your entire life. I don't know how you feel about that one.
No, I mean, why do we allow people to declare bankruptcy on all sorts of other loans, but not
gambling debt?
Yeah, but not on their education loans. It's just to protect those who've made the investment in the borrower, I guess. And it's pointless because the government doesn't need the money. It's
yeah, exactly. So Mike Maloney's response is he says, okay, yeah, there's a real estate, stock market, student loans, auto bubbles. He brings up in Puerto Rico that there are some houses that can't get insurance, for example, because they have wooden roofs, which means that they can't get, I guess wooden roofs get blown off too easily in a hurricane, which means that they can't get a mortgage and have to be purchased for cash at half the price. And he says this is a sort of preview for what's to come in the rest of the world. I'm not connecting his points.
Sorry, I don't get. Can you explain?
Yeah. So he brings up these bubbles, and then he says in Puerto Rico there are now some houses that can't get insurance. For example, they have wooden roofs, and I'm assuming that insurance companies are like, hey, there's too many hurricanes, we can't insure this anymore because the roofs just get ripped off too easily. And so these houses can't get mortgages because they can't get insurance, and they have to be purchased for cash at half the price. Now, I don't know what idiot is spending money on a house that can't be insured. But Mike then says, this is a sort of preview of what's to come in the rest of the world. What? So the rest of the world's going to get hit by a hurricane and half our houses can't get insurance? And therefore we can't have mortgages?
Maybe he's just saying the aspect that you can't get mortgages. He expects that to happen.
But I mean, that's a legitimate reason not to have a mortgage if you can't get insurance on a house. I wouldn't put a mortgage on a house that couldn't be insured.
Right. I mean, or it's all comes down to cost. I mean, you factor in the cost of not being able to have the insurance, I guess, and then you adjust all the other.
Yeah, and you get an interest rate of like 90%.
Yeah.
It's like there's hurricanes every year in Puerto Rico and a wooden roof. We need an 80% down payment.
I mean, one big point that I want to make about all this bubble and everything talk is that we had a peak in a private debt to income in 2009 that was at close to 3 times. So the debt of private households, that is financial business, credit market instruments, households and nonprofit organizations, and also non-financial loans, etc., divided by gross domestic income of about 3 times. And then from 2009 through 2016, that leverage dropped to 2.3%. And since 2016, it's been hovering around that level. So we're far from the levels of leverage that we saw back in the 2008 crisis, as we said, as a result of draining the private sector of net savings. So the private sector goes in debt to itself, to where I wouldn't necessarily, I wouldn't necessarily say that we necessarily have bubbles in all these things.
Yeah, I'm in the same boat as you. He then says, Mike Maloney, economies around the world are so linked that the bubble could pop from anywhere. For example, it could pop in China. It could be like the Australian real estate market and could cause a chain reaction that takes the whole world down. And it's going to be worse than 2008. You got a response to that?
Well, we just said that the data doesn't seem to support this, at least in the U.S. Now,
but I mean, let's go to the chain reaction thing. Let's say
it's not a huge economy compared to the U.S. economy. So yeah, maybe there's going to be a crash in Australia, and some investors will get hurt.
But I don't see how that's going to cause the U.S. to crash.
Right. I mean,
maybe they'll buy more bonds or U.S. bonds.
But you see, these people think that we're in a bubble. It doesn't matter. Everything is a bubble. Everything is always a bubble that needs to crash at some point. And that goes back to what Mike Maloney said earlier. Yeah, maybe one day we're right.
Well, that's what he says right here. So I know I've been crying wolf, but something is going to happen within the next year or two, and the people who aren't prepared are really going to get hurt. So then Stef says, we're at minute 39. We're at the end. Let's see if we can sell people on doom. He explains why the doom is a good idea, and because the sooner it occurs, the sooner we can get over it, and the sooner that the welfare state will be starved on the other side of the crash.
Well, I just sent you a tweet that summarizes.
I'll read it.
This thinking, yeah.
Austrian economists are perma-bears, bear meaning bear market. Meaning market going down. Austrian economists are perma-bears because they think by pushing rates down, the Fed causes misallocation that inevitably has to be liquidated. It's not empirical. Fed manipulates risk-free rates up. Investments are made based on other factors, and they may well be sustained. So what we're saying, or what you're saying here, and I'm agreeing with, is no, we do not need to sell people on doom. And in fact, the evidence is pointing us in the opposite direction. And there's no reason. And it's not that we're kicking the can down the road. There doesn't have to be doom.
Correct. I mean, it's intuitive too, right? We have all these things around us. We have houses, we have factories, we have people. Like, where does this doom suddenly come from? It can only come from
we sucked it in from outer space.
Right. It can happen if we suppress our capacity to do business, if we overtax the private sector, if we make the private sector go in debt excessively as a result, and then don't do, and there's no fiscal adjustment when the subsequent crisis occurs, then yes, it can happen, but it doesn't have to happen out of some natural, magical
business
necessity.
Cycle. Yeah. Then,
and also, yeah, it can happen if we have a absolutely disastrous wildcard event of some kind. Yeah, then maybe, but again, not out of necessity.
Not out of necessity, and with very simple policy decisions, we can avoid this.
Yes.
Incredibly simple policy decisions.
What's Mosler's? Is that a Mosler's law?
Yeah, that there's no problem that a big enough what is it? Spending increase, fiscal adjustment can take care of it. Yeah, thank you. Not spending increase, but fiscal adjustment. Mike's last point before it's not the last thing he said, but this is the last point on this topic of the economy and doom, is that he predicts that a crash will cause more people to turn to socialism and communism because when people lose everything, they tend to vote to take away the stuff from people who still have something. I completely agree with this.
Yeah.
I completely agree with this, which is why we're making this video, because we're saying this doesn't have to occur.
Right.
And if we learn it and we say, hey, the difference of this is simply a policy decision, simple ones. We can stop worrying about the specter of communism that's going to annihilate us once everything crashes.
By avoiding the drain of net private savings, we can avoid all of this supposed disaster that has happened in the previous times that we've done it.
And then to reemphasize, there's three main ways that we can avoid that. You can increase spending, you can decrease taxes, or you could change the trade balance for more exports.
Yeah.
Now, we're not big fans of increasing the spending. we are huge fans of decreasing taxes.
Yeah.
And the imports and exports are a little tricky because that's not just a policy decision. That's like changing the international economy over a long scale. But even if and whatever the trade deficit is doing, let's say between us and China, the policy decision, which is the decreased taxes or the increased spending, can make up for it, right?
Correct. It can and it should, yeah.
I hope anyone listening to this, I mean, we don't mean to rag on Stef and Mike here. They're obviously both very accomplished and very smart individuals. It's just that in terms of economics, it's important to point out that this isn't just academic nitpicking. It's doom predictions. And their solutions, which is, at some point we have to take care of this deficit, we have to take care of this government debt, and by take care, what's meant is get rid of it. That's going to cause the doom that they're predicting.
Well, and also, a lot of this doom porn, I mean, just makes people buy gold. I mean, honestly, I think a lot of these people just want to make people buy gold as their only safety net. And just today, there's a news bite on Kitco. Paulson and Co. closes down gold fund, returns client capital.
Why?
Just because the gold has been acting too boring, I'm guessing. I mean, actually, that's what he says in there. That
you mean you can't get enough off. Your investment doesn't return well enough.
Right, and that's because people think, well, I just got to put everything in gold, and then that's going to grow exponentially, or it's going to grow hugely, and I'm a great investor. But gold is not really a long-term investment. If you put money in gold in 1980 and you held it through 2001, you would have lost something like 70%. That's
you mean
not
from inflation to value sort of thing?
No, I mean, literally the price of gold came down between 81 to 2000. It came down from something like $800 to something like $200. Because if the Mike Maloney disaster scenario occurs and the economy does well and we have a great boom, that's an absolute disaster for gold investors. I just want people to be aware of that. If you put all your eggs in that basket, the scenario of an economic boom is a total disaster for you. And I don't think anyone wants that for their money. I don't think anyone wants to invest like that, where they don't benefit from an economic boom at all.
Well, that is certainly an interesting correlation to point out. And with that, I think I've had about enough. I'm guessing you've had about enough. And I'm guessing anybody listening to this has had about enough. So,
and actually, I just want to say I'm a huge gold.
Go ahead.
I'm a big gold buyer. I'm not knocking gold. I think there's a purpose for gold. It helps your portfolio in certain situations when you need it. For example, when you have disasters. For example, when you have strong inflation.
Wars,
depressions. Then you need gold in your portfolio because it helps you. But I still see a lot of people actually on kitco.com, you can see in the news every day, now it's going to happen. Gold is going to break out to 1,500 and then it comes back down and they're disappointed. But now it's
I thought we were going to see $10,000 gold at one point.
Right. So it's just constant hoping and praying and waiting for it to go up just so that your investment materializes. And I would just recommend to keep an open mind for all possible outcomes at all times. And I invest accordingly. And I would recommend that to anyone who is interested in growing their money and their savings on a prolonged and sustainable basis.
Excellent. All right, Nima, with that, I'm going to say we've had enough, and I thank everyone for listening, and I thank you for coming on, and we will speak again soon.
Thanks, Dylan.